we are with a very time-sensitive financing update with mortgage specialist Andre Persaud, right?
Yep.
Excellent. Okay, so the government's dropped the bomb again.
Yes, they have.
Okay, so let's get right into it.
Okay, so what happened, what was announced yesterday is that the government is going to be implementing the stress test on people putting 20% or more down. Now, if you'll remember, about a year ago, this stress test was implemented on people putting less than 20% down. So what this stress test means, when you're qualifying for a mortgage, you're essentially qualifying for that monthly payment. How much can you pay on a monthly basis? And the monthly payment is often based off of what your interest rate is, as well as your amortization, and what mortgage amount is. So previous to the stress test, you can qualify based off of what your actual rate was that you were getting. So if you were getting a 5-year fixed rate at 3%, you would qualify for that payment based on the 3%. And the change is that this stress test, what it does is you now have to qualify, everyone across the board, including people putting 20% or more down, has to qualify based on the greater of the Bank of Canada's benchmark rate, which is currently 4.89%, or whatever rate you're getting plus 2%. So let's say you're getting offered 3.2%, you have to qualify for a mortgage payment based on 5.2%, not the 3.2%, which was previously allowed for people putting 20% down or more. So
this is going to be in effect, though, January 1st, 2018.
Correct. So this is going into effect January 1st, 2018. They have not released a lot about timelines as to when, if people are pre-approved or if they're, if they have an approval on the system but closing after January 1st. But to go off historically how they've done this with the previous implementation of the stress test for people putting less than 20% down, it was usually people need to have an accepted offer on a purchase or an approval on a refinance before January 1st. So
in other words, by December 31st, 2017, if you're a buyer, to really protect yourself, you should have that offer accepted by December 31st, 17 maximum.
Correct. Because really, I've done the rough math on this, and it's about a 20% drop off on how much you can qualify for once this is implemented January 1st. So
yeah, say that again.
So 20% drop off roughly of how much you qualify for.
If they qualified for $800,000 beforehand, and they're putting more than 20% down, now 20% off of $800,000 is $160,000 less. That means now they can only buy $640,000.
Correct.
Okay, so what do you think the buyers are going to feel about that?
So that's a really, last year when this happened for, again, the less than 20% down individuals, it was really tough because we had buyers out there that were looking at properties that were maybe $700,000, and they'd seen 5, 10 properties that were in that $700,000 range. Now they've got to go back and look at properties that are significantly less in the $500,000, $550,000 range. And it becomes very difficult to be looking at, properties in a certain market and have to make that shift.
I mean, absolutely, and we're all the same that way. I mean, once we have our hearts and our minds and our financials say that we can qualify for a higher amount, and we go, okay, that's fine, it's comfortable, and we qualify, we have great credit and all that. And in this case, we're talking about the people that have over 20% down, so they've already earned the right to be more creditworthy.
Correct.
Because they got more than 20% down, plus they have excellent credit. That's why they're qualifying for the A rates. But now, artificially, the government's saying, well, now we're going to put a buffer here of another approximately 20%. This is an artificial stress test. And so now, I know you can qualify for that, but you're only going to be able to purchase for a maximum of this. How does any potential rental income factor into this?
So,
So for example, if they're looking at buying a property that's $800,000, that's just one unit, no rental. However, if they're also looking at purchasing $800,000, but there's a rental in the unit, and let's say that rental, for example, is getting, say, $1,000 a month.
Yep.
Okay, that $1,000 a month rental, is there a way of them factoring it in so that they can qualify for more?
It can, if the rental unit is considered legal and conforming and registered with the city, they can have that rental income to help them qualify. I'll tell you, as someone who owns properties who does have rental units, we had a basement apartment in our first, in our property we live in now, we've converted into our single family home. Most of them are not necessarily considered legal, so I wouldn't necessarily consider that when it comes to qualification purposes, but where you can consider it is on your monthly bottom line. I mean, you can always look at it as $500 per month in rental income equates to roughly $100,000 in mortgage. So if you're getting $1,000, they're really covering about $200,000 of your mortgage.
That's exactly right. Because the property that I showed yesterday, as a matter of fact, actually had a rental unit that the market rent is now $1,500 a month. That covers roughly $300,000 in mortgage. That's what I explained to them, and they were super excited about that, right? So I mean, that's significant. That means somebody else is covering up to $200,000 or $300,000 of your mortgage, depending on what their potential rental income is. Now, and so you have to take a look at your bottom line, like you said. So even though you can qualify for that, isn't it nice to have that cushion? That when it does rain and when it does snow and when the government does put in a wild card factor like this, that you still can have the peace of mind, and everybody wants peace of mind, knowing that, hey, no matter what else happens, we've got $1,000, $1,500 that somebody else is paying to help us pay off our mortgage. I mean, how awesome is that?
Yep.
So, and I also found out that people are getting creative, because when the government gets tighter on the guidelines, then some people, even though it's not legal, they're renting out rooms, especially if they're near colleges or university. By the way, that's not legal. Many people do it though. Now, just for warning, if you do get a bylaw enforcement visit, then you're probably going to be shut down. So if you need that to survive, to make the mortgage payment, then you should be looking at other options. If it is a proper student rental, then that is legal and authorized. So that's something to consider, to make the dollar stretch further. However, the government's really, what's the government's rationale, do you think?
So I talked to a lot of mortgage professionals in the industry. We've been talking a lot over the last 24 hours across the country, and we really can't figure them out. The default rate on mortgages, especially when people are putting more than 20% down, is extremely low. People putting 20% down do not default on their mortgage. So I don't understand.
From what I understand, it's close to zero.
Correct.
Exactly. So it's like penalizing somebody for not doing anything wrong.
Correct. Yeah. So I mean, we're all a little puzzled by this.
So the financial gurus can't figure out the government either.
Correct.
Neither can the real estate communities. Okay. So when it comes to the government, they are, as stated before, they're the wild card. They don't need to operate on logic. This is definitely not logical.
Correct.
Okay. We don't know what it is. It's just bizarre.
Yes.
Yet it's all of Ontario.
Yes, but I mean, it's a reality. It is the reality, and one thing I would encourage people to do, if you're on the buying side, you may want to consider at least checking to see, what do I qualify for before the changes? What do I qualify for after the changes? Now, if you are putting less than 20% down, you are not impacted at all. But if you are putting 20% or more down, you may want to inquire to say, what do I qualify for now? What do I qualify for after January 1st?
So really, any buyer that is putting more than 20% down is definitely in a more favorable position to purchase something, get a solid agreement of purchase and sale before December 31st. There's quite a bit of inventory out there. Take advantage of the situation, because this time of the year there's less buyers looking and you're going to have less competition. Plus you get to qualify for up to 20% more, like what you really can qualify for, versus the new guidelines would come into effect on January 1st. So you avoid that risk.
Yeah, and another point to that, if you are on the selling side, you are looking to sell your home, you may want to consider, depending on what price point you're in and what your expected potential buyers look like, you may want to consider putting your home on the market sooner rather than later. I mean, I've got clients who said, I'm going to wait until spring of next year. and are reconsidering now because they may have a lot less qualified buyers for their home after January 1st.
Which means that the amount of equity that they think they're going to realize from the sale may go down.
Correct.
Especially the higher price points. They're going to get affected the most because obviously people are putting more than 20% down. Typically, they're the higher price.
Every property that's over $1 million,
yes,
minimum down payment is 20%. So everyone in that.
So everybody over $1 million is going to be affected dramatically, and we could see a softening of that market, right? So if you are thinking of selling, you should definitely get your house on the market and realize that equity as soon as you can. Makes sense.
Yep.
Thanks again.
No
We'll be in touch.